When you have these big sort of cataclysmic economic events, what you have is a period that's very deflationary, right? You have a period where prices fall and fall and fall. Now, in the Great Trend is to basically get rid of the gold standard, in 33, I think it was. And so we're going to have some version of that, which is to basically create a bottom on pricing and to create a bottom on price stability. So the movie theaters, more than likely, that if you were a REIT or if you were a tenant or if you owned the land, you're going to have to figure out how to repurpose that, how to try to pay your debt obligations. Otherwise, you're going to go bankrupt or you're going to go default, or you're just going to hand the keys over to those facilities to banks, at which point, or some other sort of like physical retail that needs last mile distribution. And some of these movie theaters represent the right size and the right physical location. Okay, so that's one. Then you talked about startups. That's another great example. For a long time, I think in 2015 or 16, I started to become very bearish on enterprise software. And the reason was because we shifted much more towards SMB than we did towards mid-market and enterprise. And the reason was because the money cycle was faster. You could put small amounts of dollars to work. The companies would sell online via credit card to other SMBs who would buy very quickly. You would show revenue traction, and then you were able to use that to then go and raise an up round. So venture capitalists loved it. The entrepreneurs loved it. They used it to attract employees because the equity looked like it was accreting very quickly. But then you realize how brittle your customer base is in a moment like this, because they are the first to not honor their contracts. They're the first to go out of business, unfortunately, because they don't have the cash cushion. And so there's going to be, unfortunately, a lot of carnage in the SMB space that there won't be in the enterprise space. So now go back to a company like Workday or ServiceNow or SAP or some young startups that have explicitly chosen to sell into the Global 1000. Netscope is one, as an example, that sells security software into the Global 1000. They consumed enormous amounts of, but in many ways, that capital becomes a protective moat that will keep them safe in a moment like this, because their customers have a higher probability of staying in business. Now, their business may slow down, their business may get re-rated, but their business isn't going out of business. But if you were selling mostly to SMBs, there's a value is impaired. And at that point, again, if you're already money losing, which most of these startups were, selling to SMBs at price points that didn't make sense because you were trying to get out of a J curve, it's going to be next to impossible. The other strategy that startups also employed was being monoproduct, right? It was not only go to SMBs, charge something small, if anything at all, but do it for one single point solution, create a wedge, and then expand. Problem that when companies are
you, I think, actually made like $1.5 billion last year alone. What was the moment that you realized, wow, I have $1 billion net worth?
Wow, answer, but it was a while ago, in my early 30s, as it happened to be. But that was, pure luck. Like, it's not as if it was just sort of what the outcome was, through a process of realizing that it didn't really solve any of my problems. And for a while, it amplified most of my insecurities. And then it took me a while to just become a more kind of, normal person and less of a insecure person going through, their bouts of inferiority. So it was, I guess now 10 years ago. I'm 43, so it was, I guess, about a decade ago. It was great. It was a real notch in my belt. Now, what I'll tell you though is it's been a crazy journey, because the last 10 years it's gone up, way up, then it's gone down. I've had to rebillionize a couple times. It's been fucking great.
I feel like when you start playing with big sums of money, people forget not only can you compound it faster, but you can also lose it faster.
Swings are really big. And, you really have to, this is why I kind of like have really tried to migrate to a much more patient model of doing my job. First, I was trying to figure out what should my job be. And I don't think there is a job that is an investor. I actually don't think that job exists. I think that if you're going to allocate capital well over decades, what you really are better than anybody else is just a good observer of the current moment in time. And it's taken me a long time to sort of practice and refine a toolkit, which all comes back to my psychology. And so, in deconstructing myself over the last 10 years, I've become a better person. The byproduct is I think I make better investing decisions because I'm less prone to the wild swings that I went through. But in that process, I've been going through wild swings. Now, I think the swings that I go through, I can tolerate better because they're less psychological and they're more the result of bad structural decision making versus bad emotional decision making. So that's been an interesting process.
For sure. And obviously there's a bunch of chaos and kind of uncertainty in the world today. I listened to the recent podcast you did with Kara Swisher, and if I got this right, $1.5 billion or so last year. That's what you guys made. You've got 3 public positions.
1.7. Yeah.
1.7. Okay. You've got Slack, Virgin Galactic, and Amazon in the public markets, and then mostly sitting in cash, I'm assuming, other than whatever illiquid investments you've made. You keep talking about, hey, we're only 4 weeks into kind of this drawdown. If you look historically, that's pretty early, or kind of the beginning of the beginning, I think is a quote you used. What are some of the things that you're paying attention to that you're like, when I see X, that's when I'll start to get excited and start getting a little bit more aggressive, and kind of switch from an all cash mindset to aggressiveness?
Yeah, so I think the setup is important here. So yeah, last year we were lucky. We put about 1.7 billion on the balance sheet. I had been trimming all this year. And so I'm not going to be the one here to tell you that I've been trimming at the top. I haven't been. I've been methodically selling more and more every day. I had 4 positions coming into this year: Virgin Galactic, Tesla, Amazon, and Slack in the public markets. We have a large portfolio of private equities. I don't really know where the market on that is. I tend to think it's probably down at least 30%, and ours is a pretty good portfolio, I would say. And so I think many companies could be down 60 or 70, if not completely out of business. So my mindset has been to position myself defensively, build up a cash base that we can very aggressively put to work. And so what signals am I looking at? Well, first is the signals that maybe what we're doing is the right thing. The best way that I think about this is just put yourself into the mindset of any company, right? So pick a great company that, you've admired. So I'll pick one that I've admired for a very long time for good reason. Workday, simple example. That's a company that's basically like 10x their market cap in, the 6 or 7 years they've been public, trading at an incredible valuation, cheap now. In terms of sort of like what they've done historically. But then I put myself into, and this is not to pick on Workday, but it's a perfect example of what other companies will go through, because I think this is one of the best positioned companies. So they were, before all of this craziness, going to companies, the Global 1000, and basically saying, listen, like, you need to upgrade 2 big parts of your legacy infrastructure, right? One part is about how you do all of the human capital planning and human resources management of all the people that work for you. The second piece is how you actually count all the money that you make, your general ledger, right? And so the first product would compete against PeopleSoft. The second product competes against Oracle Financials, okay? Now, why am I telling you this story? Because it's kind of like, who cares? Boring enterprise software. Well, now you put yourself into Workday for a second and ask yourself, who are their customers today, April 1st, 2020? Well, whatever segment of their revenue came from oil and gas just went to zero, right? Oil is at 18, 19 bucks a barrel. There are a lot of very smart people that are telling you now that oil probably gets to 15, if not $10 a barrel. Some could go to zero. You've had the tar sands effectively trade to zero in Canada. You've had your first bankruptcy filing this morning when we woke up, which was a multi-billion-dollar company in the Bakken Shale in North Dakota. So if you're an oil and gas company, you're no longer thinking about your general ledger because you have no revenue. And you're no longer thinking about upgrading your HR software because you may not have any employees, right? So that whole segment stops buying. If you're an airline company or a transportation and logistics company, that whole segment has stopped buying. If you're a hospitality business, that whole segment has stopped buying. If you're in the banking sector, that whole segment has stopped buying. Now, the spectrum of decisions are different. On the one end, these companies are bankrupt. At the closest end in banking, your market cap has been shaved by 30 to 40%, which means that you have to now start and figure out how you save from an OPEX perspective a lot of money to basically try to get profitability in line so that you can grow out of this thing. And so decisions that you could otherwise live without, you stop. And decisions that you could otherwise stall, you stall. Now, this is for one of the best run companies in the world. So then if you take that trace route that we just did and trace route a bunch of other companies, random companies, pick a retail business. Let's take a retail business, Macy's. Okay, well, what was Macy's spending money on? Well, they were spending money on people. They just furloughed 200,000. They spent money on physical plant. They're going to stop paying their rent. They spent money on point of sale software. That's going to go to zero. They spent money on merchandise. That's going to stop. And now you look at their customers. Well, the customers, the point of sale manufacturers, right? Let's look at those companies as an example. I think there's about $15 billion of public market cap in folks that sell POSs. POSs used to stand for point of sale. It may now stand for piece of shit. The entire category has gone to zero. The entire category. $15 billion of market cap has been eviscerated. Nobody's buying point of sale software or hardware or terminals, right? If you think about all the OPEX that those companies spent, $5-6 billion a year in running their businesses, they've stopped. So my point is that when you start to follow the trail of breadcrumbs for any company in any sector, what I am slowly realizing is that we're a very interconnected web of businesses, and that as much as you thought you were insulated from what's happening, I tend to think that what is going on is not a sector-based drawdown in leisure, hospitality, banking, and a couple of others, but there are implications for every single business. So why that's important is for a company to reset. I think you're going to start to hear the term zero-based budget a lot. So what is zero-based budgeting? Zero-based budgeting means you start with a clean sheet of paper and you say, well, this company is worth nothing. I have no revenue. Let me build it back up, bottoms up, line by line, excruciatingly line by line. And when you do that, you'll understand what you're willing to bear in your expense basis, right? So I tend to think in that process, that takes 6 or 9 months to unfold. People will not be in a position to buy things that were nice to haves. People will not be in a position to actually even spend on must-haves. So if you think about, like, if you're an energy business and you're thinking about, look at even Buffett's businesses. I mean, the craziest thing about Buffett's letter this year was how economically capital intensive and unproductive his energy businesses were. They're negative ROE. Well, in a world where, you have energy consumption falling, I think the average power consumption has fallen by about 15% for the regional utilities, but you're forced to price within a band, and you're also forced to do certain capital upgrades, especially in the case of what just happened in California, where you could get sued because you have faulty equipment, you start a fire, blah, blah, blah. Every single company is going to be under an enormous amount of pressure to re-baseline their expenses. And in these next 6 to 9 months, they're going to figure out what they're willing to spend. And then they're going to start spending cautiously, I think. So I tend to think this is a multi-year, and I don't want to become too alarmist, but I do think it's something that is sort of akin to a depression. Like, this is 15 to 25% unemployment, and it's going to take a long time for us to sort through all the damage.
Yeah, you bring up a really good point. I saw a stat yesterday that the U.S. domestic box office, so kind of just movie theaters in general, this time last year, in the week March 20th to 26th, they made $200 million. Last week, they made $5,100. I mean, literally 99%,
Oh
just
God.
decimation. Now, that immediately brings the idea of like, hey, are you going to see an industry basically evaporate, right? Will people ever go back to the movies with the virus, et cetera? And a buddy of mine said to me, well, that's the movies and that's kind of a nice to have, right? People have Netflix or other ways that they could get some of that content. Is what about all the startups that were built that just service other startups, right? That was the rage for a number of years. And so it sounds like you're making the argument like this isn't just hospitality or movie theaters. This could be kind of across industries, depending where you are and what your balance sheet looks like. There could be disappearances.
You're bringing up some really good examples. So let's follow those examples. Let's trace route those, right? This is a key word, trace route. Fucking follow the trail of breadcrumbs. This is now the time where honestly, like the propensity to action should be avoided at all costs. Like this is where you sit down, you tape your hands to your hips, your lap. You don't touch the fucking keyboard and you just learn and you study. You're not supposed to be day trading in moments like this. You're supposed to be learning. But let's take your examples. So, the major movie studios were forced essentially to go day and date. Now, the problem with that is that you can't put that genie back in the bottle. And the other problem with it is that they may have gotten the pricing wrong. They had no time to really do a pricing elasticity and release these movies for $100 a ticket on iTunes. They released them for $20. And so it's going to be very difficult for Disney and Universal and Warner Brothers and Sony Pictures to all of a sudden come back and say, we're going to try to give the movie theaters back their window of exclusivity. I think that's basically very difficult, if not impossible. And then the second thing that's going to happen is that they're not going to have the same pricing power that they would have had with the online distributors. Now, all of that has one really important implication, which is the cost of the movies that they make are going to change. And then as a result, the cost of what they're willing to pay is going to change. As a result, the cost of what they pay their unionized employees is going to change. What the CGI maker, charges changes. What the caterer charges changes. And so this is why when you have these big sort of cataclysmic economic events, what you have is a period that's very deflationary, right? You have a period where prices fall and fall and fall. Now, in the Great Depression, the only way that we could buck that trend is to basically get rid of the gold standard, in 33, I think it was. And so we're going to have some version of that, which is to basically create a bottom on pricing and to create a bottom on price stability. So the movie theaters more than likely go BK. And in that, if you were a REIT or if you were a tenant or if you own the land, you're going to have to figure out how to repurpose that, how to try to pay your debt obligations. Otherwise, you're going to go bankrupt or you're going to go default or you're just going to hand the keys over to those facilities to banks, at which point, probably the beneficiary is Amazon or some other sort of like physical retail that needs last mile distribution. And some of these movie theaters represent the right size and the right physical location. Okay, so that's one. Then you talked about startups. That's another great example. For a long time, I think in 2015 or 16, I started to become very bearish on enterprise software. And the reason was because we shifted much more towards SMB than we did towards mid-market and enterprise. And the reason was because the money cycle was faster. You could put small amounts of dollars to work. The companies would sell online via credit card to other SMBs who would buy very quickly. You would show revenue traction. And then you were able to use that to then go and raise an up round. So venture capitalists loved it. The entrepreneurs loved it. They used it to attract employees because the equity looked like it was accreting very quickly. But then you realize how brittle your customer base is in a moment like this because they are the first to stop paying. They are the first to not honor their contracts. They're the first to go out of business, unfortunately, because they don't have the cash cushion. And so there's going to be, unfortunately, a lot of carnage in the SMB space that there won't be in the enterprise space. So now go back to a company like Workday or ServiceNow or SAP or some young startups that have explicitly chosen to sell into the Global 1000. Netscope is one, as an example, that sells security software into the Global 1000. They consumed enormous amounts of capital to build their go-to-market. But in many ways, that capital becomes a protective moat that will keep them safe in a moment like this because their customers have a higher probability of staying in business. Now, their business may slow down, their business may get re-rated, but their business isn't going out of business. But if you were selling mostly to SMBs, there's a very good chance that 50% of your revenue is impaired. And at that point, again, if you're already money losing, which most of these startups were, selling to SMBs at price points that didn't make sense because you were trying to get out of a J curve, it's going to be next to impossible. The other strategy that startups also employed was being monoproduct, right? It was not only go to SMBs, charge something small, if anything at all, but do it for one single point solution, create a wedge, and then expand. Well, again, you go back to this problem that when companies are rebuilding their expense base, what they're doing is making decisions about what costs to bear. The company that has a monoproduct solution is last in line to be considered because it doesn't solve enough of the CEO, CFO, CIO's problems. So then all of a sudden you start to make substandard decisions, meaning you'll take Microsoft because it's a whole stack of things. It's one person, it's one sale. They can now discount